It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Rate cuts are pretty much off the table for now. I know there's a bit of talk from some of the economists about rate hikes next year. I don't necessarily buy into that either. I think we're probably going to be at a point where the RBA waits and watches, as opposed to suddenly going from we're cutting rates to we're raising rates.
That is Omkar Joshi on the Real Estate Breakfast this morning, and we'll get back into that conversation in just a moment as we continue, breaking down the ever-changing, colourful Australian property market. Always a new talking point to cover off every morning with your breakfast. And thank you, Ross, in London, for getting in touch. Another expat coming home to Melbourne in the new year after 7 years away, Ross. And you have asked us who we could suggest to connect you to an agent on the ground, which we have already done. And just a reminder, because we are not a real estate company, we have curated this master list of agents and companies across Australia who we trust and recommend. You don't have to be an expat like Ross in London. You might be wanting to list into the new year locally your property, and you just don't know what agency to engage with. Well, in that case, you can email us and we will make a preferred suggestion. Our email address, as always, myrealestatepodcast@gmail.com. And Ross, let us know what you buy, and thanks for getting in touch. Well, it's a Wednesday, the middle of our working week, December the 3rd. Now, this is pretty interesting stuff. 18 years after the GFC, the global economy may be edging towards a new kind of crisis. Not from bad mortgages, but from an AI-fueled stock market bubble in the United States. With AI driving extraordinary valuations at the moment, the risk of a sharp correction is growing. The history shows that when Wall Street catches a cold, Australia often sneezes with it. And in 2008, the shock rippled through our housing market, fair to say, for years. If today's AI boom becomes a bust, what happens to the Australian property market? Let's catch up with Omkar Joshi. He is from Opal Capital. And good morning to you, Omkar. Welcome into the Real Estate Breakfast. Yes, just coming back to that point, if an AI-driven stock market bubble bursts, the first instinct is to assume that property prices are going to fall. But ironically, a sharp equity correction could push interest rates lower as policymakers move to stabilise the economy. Is that fair to say?
Morning, Craig. I would necessarily agree that while equity prices may fall and that may dampen sentiment, you're right in that depending on how bad things get in the real economy, you could actually see interest rates getting cut. And obviously an interest rate cut would be positive. I guess the one overarching comment I'd say on all of that is to see how bad things get in the real economy. And as it currently stands, while there's a lot of talk of an AI bubble, a lot of it really is an overvaluation. But there's no clear reason just yet around why we're going to see a big burst or a sharp correction in equity prices at this point in time. While there's an overvaluation, that can last for a lot longer than you expect. And so I wouldn't necessarily say there is going to be a big burst coming anytime soon either. And, frankly, you could have said that it looks like a bubble even 6 months ago. You could have said that 12 months ago as well. So we've been in this situation for a little while. We've seen historically as well, bubbles can last a lot longer than you expect. And there may well not really be too much of an impact on the real economy. It's definitely not like the financial crisis from 2008 in terms of the setup and where we're at.
Interesting about the overvaluation, because just last week I made the comment about a New Zealand super fund back in 2010. They made an investment of $300,000 in NVIDIA. That is now valued, their investment, their $300K, valued at $3.2 billion. So that's a bit of a point in case, isn't it?
That's exactly right. They've obviously done very well on that. And I think that's a very important point as well, is that although you might say we're in a bubble now and we might have a crash, it's important to remember that a lot of people have actually been on this way up for a long time. So although we might have a correction from where we sit today, the people that got in the last year, last 2 years are maybe the ones that feel the most pain. But there's a lot of people that actually are still in a pretty good position because they've been on the trade for a lot longer than that. So it's not all doom and gloom for everyone is probably the important way to look at it.
Shame that we weren't on that, eh? Because if you had a lazy 50 grand, that would be worth $383 million. Boy, that'd be nice leading up to Christmas.
Exactly.
Now, Australia's housing market, it has this long history, doesn't it, of performing well in unlikely circumstances, even during the global disruption. So a correction in the AI sector might spook financial markets, but people at the end of the day, they still need somewhere to live, and demand continues to exceed supply.
That's exactly right. And if you look at it historically, our housing market has always been a lot more resilient than some of the other markets overseas. And that's also a function of the fact that our lending has been a lot more controlled, a lot more careful. And our regulators have also done a good job in terms of making sure the banks are actually doing a good job as well from that perspective. And so from that setup, you can see that we don't have the same issues that, say, the US market had in 2006, 2007 with subprime lending and everything else that was going on there. So our market is definitely set up a lot better. You've got a strong undercurrent of demand coming through, and you do have a constant supply shortage, which has been a problem as well. So I really don't think that we have the makings of a big crash or anything like that. Even if there is a burst in the AI bubble, it might be a bit of a sentiment dampener, but beyond that, nothing's actually changed in terms of the fundamentals.
Might be a really nice time to go and watch the movie The Big Short, especially if you're listening this morning and you're just not quite sure of what happened last time. I've seen that movie, I reckon, probably at least four times now, and every time I watch that, I learn something new.
No, I totally agree. I mean, that it was a very interesting movie and a very different setup, though. I think that's important to remember as well. And I think one of the biggest differences between our housing market and what the US had there was the fact that we don't have non-recourse debt. Well, ultimately, if you can't pay the mortgage and default on it, then you can't just hand over the keys and walk away from it. And that setup is incredibly important in terms of understanding the differentiation between the two markets. And like I said, our regulators have done a very good job in terms of making sure that the lending that's being done isn't out of control and isn't irresponsible, and it's been pretty well managed. And we've even seen APRA talking about macroprudential controls last week as well, where they're very well and truly ahead of the game in terms of making sure we don't end up with an overheated market and the fundamentals actually can prevail.
If an AI bubble breaks, the biggest question for housing isn't what happens to tech stocks. It's really what happens to the job market. Like a slowing economy could trigger rate cuts, which normally support property demand. But if unemployment rises sharply, for example, mortgage stress increases and buyer confidence fades. Is that a fair observation?
That is a fair observation, but one important distinction I would make is that while you might have a bubble break in terms of AI and what's going on now, it doesn't necessarily flow through as materially to the real economy as what we had in the financial crisis. And what I mean by that is that in the financial crisis, you had a lot of people being affected, unemployment rising, whereas with the AI bubble, a lot of it is to do with the pricing of some of these computer chips and the overvaluation that's being brought in from that, as opposed to a lot of jobs in the real economy being unwound rapidly in the event of a bubble breaking. And I think that distinction is quite important because then you don't have a scenario where unemployment materially rises. Sure, you'll probably have a little bit going up, but you won't necessarily have a big increase in unemployment, big increase in defaults and arrears, and a lot of houses suddenly coming to the market. So it's quite a different setup, whereas I guess the financial crisis did have its, the fundamental problems being built in the housing market. The AI bubble is a little bit removed such that it won't have as much of a direct impact. And so it's going to have less of an issue if something does go wrong there.
You know, in all of this, we've also got the whole psychology. I mean, psychology in any market, money markets, it's so huge. Like the impact of an AI bubble burst may be felt more in sentiment than in the actual hard numbers. Housing markets do run heavily on confidence, as we know. The belief that tomorrow will be better, that rates will fall, that scarcity will support prices. A dramatic US tech correction could shake that psychology, sparking caution among buyers. And then, of course, people might delay big decisions, spending slow, and the market temporarily cools. But maybe, just maybe, unlike 2008's credit freeze, the fundamentals supporting property would, as you've already said, remain far stronger.
Yeah, no, I totally agree with that. So sentiment is very important in all financial markets, and ultimately everything is interrelated. So if we do see a sell-off in the stock market, there is going to be a bit of a dampener on sentiment and the mood, but ultimately it doesn't change the fundamentals. And that's the key differentiation. That's why you're not going to see necessarily a big sell-off or a big crash in housing. Ultimately, housing does rely on employment. As long as unemployment stays low, and we've seen the economy is actually in good shape, and that's why we're not talking about rate cuts, which is actually a good reason to be not talking about rate cuts. And on top of that, you haven't seen house prices falling either. So unless you have a combination of falling house prices and unemployment rising, you're actually in a pretty good spot. And that's basically where we're at. But of course, the sentiment could easily weigh on the mood short term.
Yeah, we're in December, and perhaps I'll ask you just to cast your mind across 2025, maybe looking at the RBA, and while the RBA has done this year, of course, we've got a change of governor as well. Things feel a little bit different. There's the talk that maybe we've hit the ceiling as far as no more rate cuts. What's your take, on the report card for 2025 as you look back?
Sure. So I think we've had 3 rate cuts this year, and the market was pricing in more rate cuts. It's fair to say where we sit now with the inflation print that we saw in December and in November, rate cuts are pretty much off the table for now. I know there's a bit of talk from some of the economists about rate hikes next year. I don't necessarily buy into that either. I think we're probably going to be at a point where the RBA waits and watches, as opposed to suddenly going from we're cutting rates to we're raising rates, because that's frankly, it's not a very good way of running policy, and it doesn't actually help in terms of explain to the broader economy and consumers about what you're actually doing either. So I think we're in a situation where we've had 3 rate cuts. Inflation has not come down just yet enough to justify more or warrant more. The economy is actually in still a pretty good spot, so you don't need more rate cuts. So the rate cuts aren't necessarily a good thing anyway, in that we've even seen the anecdotal feedback so far from Black Friday. Sales are good, retail sales are good, the economy is in a good spot. And so over the next year, you probably have a situation where the RBA waits and watches. You don't have any rate hikes, you don't have any rate cuts, but the economy continues to move along at a reasonable pace.
Yeah, probably keeps you sort of commentating on lots of different things, and that is going to continue into next year. Good stuff, Omkar. Great to be talking to you for the very first time. Enjoy your Wednesday, and thank you so much for coming on to the Real Estate Breakfast this morning with your thoughts.
Thank you, Craig. Thanks for having me on.
Remember, we are not a real estate company. We are 100% all about increasing your awareness and knowledge for buying and selling properties.
Those homes will start at around that 135 mark, which is your median, and then go right up to, there's probably homes in there that are over 3 million. In the older part of the suburb, you're going to be getting something that's on a larger block that might be one of the original homes. It was a big market garden area. So you've got a lot of homes that are sort of from the, I'd say, 70s and 80s. They might be on a 720 block.
We should have a look at the unit market, especially with the first home buyers scheme that is kicked in. This is just kind of ramping everything up in the unit market. Is that what you're finding where you are?
Absolutely. So I think since 1st of October, since that scheme came in, there's been a real urgency around first home buyers to get into that space. The average price point for a unit in Sterling is around that 750 mark. So that's a good sweet spot for those buyers. But I'm finding that, I believe, will increase up to that 850 mark pretty quickly, I reckon.
We connect you to the best real estate information across Australia. The Real Estate Podcast.